All right. Excuse me. This chapter is one that is kind of looked at in a lot of cost textbooks because it's a favorite area for uh, writers of the CPA exam to ask you questions. One, can you do absorption costing, that is full manufacturing costing? Everything is included in cost of goods manufactured. And can you do variable costing? And more so, can you reconcile the two? Now, many companies will use variable costing for internal purposes. And that is primarily because as I change my production, the costs that are going to change are going to be my variable cost. So my variable cost can also be sort of defined as my incremental cost. However, at some point when I prepare my financial statements, I'm going to have to make the conversion, the reconciliation, to bring them to full accounting, to full cost accounting. And that, what I mean by that is all manufacturing costs have to be included in the cost per unit. Now, when you look at the reconciliation and you do the adjustment process here, non-manufacturing costs are irrelevant. They're always going to be subtracted after the fact. What's the issue here is what happens to fixed manufacturing cost. That's the element of reconciliation between these two different types of statements here. Okay, so I mean it kind of gets at what we're talking about here in question number one. My fixed manufacturing costs are in fact really my major problem that I have to deal with here. So the fixed manufacturing is the part that I'm going to have to work at to make sure that I can reconcile the two things. Okay, and under variable costing, okay, remember our strict definition. Under variable costing, a fixed cost, regardless of where it occurs, is going to be treated as a period cost. It simply gets expensed. And so the only cost that I would keep in inventory would be a variable manufacturing cost. Everything else is going to be expensed. Okay? Now, under absorption costing, part of my fixed cost is going to be in inventory, part of it's going to be in cost of goods sold. So you can kind of see that's really the essence of the dilemma that I'm dealing with here. What do I do with fixed manufacturing cost? And again, that kind of gets at question number 3 here. What is the difference? Well, no, the difference is really how much of that fixed manufacturing cost has been expensed, how much of it is still in inventory. And again, it kind of gets down to the timing of it. So a number of the early on questions as you're looking through this are looking at this issue, what do I do with the fixed manufacturing? Now, one very popular misconception is that variable costing views fixed costs as being irrelevant. No. It's the classification is not by importance, but rather by behavior. And so, in a technical sense, variable costing is going to look at only those above to look at calculating my contribution margin. Then I'm going to subtract out my other cost. Now, as my activity changes, by definition, my fixed costs don't change. So from a decision-making point of view, fixed costs are certainly important to get at my operating income. But I'm going to make a distinction. Contribution margin is, in a sense, the change in income because of the change in activity. That is, the change in sales. So, I mean, the production and sales are the same thing. And keep in mind, too, that as my production increases up to a point, that my fixed costs are not going to change. So the emphasis is on what changes as my production changes, not what is important. Now, one of the real problems under absorption costing is that absorption costing is subject to manipulation. It's subject to manipulation because I can increase my operating income by increasing my production. And what I mean by that is that if I increase my production, I spread those fixed manufacturing costs over a greater number of units of production. And if I don't sell them, part of that fixed manufacturing cost stays in ending inventory of my finished goods, and part of it goes into cost of goods sold. So one way that I can try to hold some of that back is to overproduce. And that's one of the real problems, potentially, not all the time, but potentially um, with the absorption costing. One of the other issues is that my sales can go up, but my operating income can go down. Or conversely, as my sales go down, my operating income can go up because my operating income is not strictly a matter of change in sales. That another element that's going to affect my operating income, in addition to sales, would be the change in inventory. As inventory levels change, that can have a very significant impact on my operating income. Now, one of the virtues of variable costing is that no matter what, as my sales go up, my operating income goes up. As my sales go down, my operating income goes down. So the logic, the consistency is there with respect to variable costing. That's not always going to be there with absorption costing. Now, you have to keep in mind absorption costing is GAAP. I have to do that for GAAP purposes. But for decision-making purposes, I can do whatever I want. Now, a couple of final questions here. We'll look at this issue of capacity, which is another element here. One of the things when we look at capacity, we can look at the theoretical capacity and practical capacity. Theoretical being simply, if I run it 24/7, 365 days a year, how many units could I produce? Practical capacity says, well, yeah, but maybe we can only run 2 shifts. Maybe we have to have some shutdown time for vacations, maybe for some general maintenance and things like that. So what would be a more realistic number that we could go along with, okay? Now, theoretical and practical are going to be based on what we can do, this issue of can, not necessarily what we should do. Normal capacity is kind of looking at it from the point of view of, okay, over the next 3 to 5 years, what do I think my sales are going to be? What's my production level going to be? Master budget tends to be 1 year. And so this is looking at more demand and or what I should be doing, not necessarily what I can do. So that's kind of the distinction between theoretical and practical. Look at sort of the machines themselves and what they're capable of doing, and not necessarily tying it into what the market is demanding. Normal capacity, okay, on the average, what I think demand is going to be over the next 3 to 5 years. Master budget, what's it going to be next year? Very much in line like we did when you prepared the master budget. Downward demand spiral, or sometimes referred to as the death spiral, simply means that as my demand decreases, many times I'm left with the dilemma, geez, that means I'm going to have to increase my price to cover my cost. So you can get into a situation if you need to recover your cost, even though demand is going down, I have to increase the price. So that would only then lead to my product being less and less attractive to potential buyers, so less and less sales are going to be made. Okay, we're going to look at, with respect to absorption and variable costing, problem number 16. A relatively straightforward, simple problem, but still it gets at the heart and the essence of what we're trying to get at here. Well, one thing is to take a look at what's happening to inventory, okay? And in April, they produce 500 units, but they only sell 350. So sales are less than production. And you see this, okay, that 150 units is being held back as in inventory. So in a sense, what I know is that those fixed manufacturing costs, part of them are going to be under absorption costing, part of them are going to be in cost of goods sold, part of them are going to be in ending inventory. Under variable costing, all of those manufacturing fixed costs are going to be expensed. Now, in May, I get the opposite situation, where they produce 400 units, okay, but they sell, so they plus what they began with, and they sell 520. So the sales are greater than production, and so actually inventory here is going down from 150 to 30. So you have kind of a change in inventory. It goes up in 1 month, it goes down in another, which has an impact on it. Now, the budgeted fixed manufacturing cost are $2 million. Likewise, the assumption, my budgeted rate here, is to take the 2 million divided by 500. That's my normal budget. So I'm going to budget $4,000. And in other words, if I come up, this is going to become my predetermined application rate for fixed manufacturing overhead, 4,000 per car. Likewise, too, I'm given the information that I have $10,000 of variable manufacturing cost, and so my total budget, the 14,000, is essentially would be my budgeted cost per car, 14,000, 4,000 of fixed manufacturing overhead, and the 10,000 of variable cost. Okay, now under variable costing, sales are sales. It doesn't really matter variable versus absorption. But in calculating my cost of goods sold and in calculating my contribution margin, etc., I'm only going to include variable manufacturing cost, or the $10,000 per car. So if I produce 500 cars at $10,000 per car, that's 5,000 of manufacturing cost. So the 5 million would be available. My ending inventory of 150 cars at times 10,000 gives me 1.5 million, or a variable cost of goods sold of 3.5 million. So the other thing I need to, the other thing I have to factor in here are these two things here to get at my contribution margin. In other words, here are my variable manufacturing cost, my variable, if you will, cost of goods sold. But I also have another element of variable cost. Now, these are going to be determined by a different factor. This is based on production. This is going to be based on sales. Marketing costs are normally a function of sales, production, a function of production, obviously. So if I sell, and the variable marketing costs are $3,000 per car. So if you sell 350 cars in April, your variable marketing costs are going to be 1.5 million. If they sell the 520 units, 520 times 3,000 gives you 1.56 million. So take my 8.4 in April of sales, less my 3.5 of variable manufacturing cost, less the $1,050,000 of marketing cost, I end up with a contribution margin of 3.85 million. Subtract out my fixed cost. These are going to be identical each month because they're fixed. I end up with operating income of 1.25, 3.12. The other thing that's consistent is that I know that my sales are increasing from 350 to 520. And so again, I'm seeing it's not always going to be proportional, but I'm seeing as my sales go up, my operating income is going to go up. Now, you will always see that with variable costing. That's not always going to be the case with absorption costing. But variable costing, you guys have done it plenty of times. The only thing that's a little different is the way they kind of create this income statement, where they create this, if you will, variable cost of goods sold. But that's just simply taking I'm kind of breaking out my variable manufacturing cost from my variable marketing cost. And the primary reason for that is because they're driven by two different numbers. Production is going to drive the 3.5, sales is going to drive the 1.5, the 1,050,000. Now, absorption costing you've done plenty of times. This goes back to essentially what you did back in the very first chapter that we worked on. So again, sales are sales. So I can do this however I want. Now in this case, they produce 500 units. So I take my variable cost of 10,000, my fixed manufacturing cost of being applied, 4,000, so I would have applied 2 million. I have 7 million manufacturing cost. Deduct out ending inventory. Remember, we calculated up above that the total manufacturing cost, or the variable plus the fixed, are 14,000. So 150 units of ending inventory at that would give you the 2.1 million. The 14,000 times 30 gives you 420,000 over here. Again, kind of the traditional income statement. Cost of goods sold 4.9. My gross margin is this. Now, the difference would be my treating all of these non-manufacturing costs as period cost. Whether they're variable or fixed, it doesn't matter. The big difference is that under absorption, above the line here, we're talking about manufacturing cost. Below the line that I've drawn here, these are my non-manufacturing cost. And that's the big distinction. Under variable costing, if I went back and drew the line, I won't do it. Above the line would be all of my variable cost. Below the line would be my fixed cost. Now, again, what I'm going to do here, I'm going to start with my beginning inventory and the production here. Okay, they produce 400 units. Okay, so they apply the 10,000, they apply the 4,000 here. And so again, we have the total manufacturing cost less the ending inventory. Now, this is something that's a little different. And these two numbers tie in together, the 1.6 and the so-called volume variance. Remember that absorption costing says you must recognize all of the manufacturing cost. So sometimes what will end up happening is that your production is going to be less or more than what you budgeted for. Remember, they're budgeting for production of 500 units per month. In this month, they only achieved production of 400 units. But the assumption is they incurred $2 million of fixed manufacturing costs per month. So even though they applied 1.6, I'm required essentially to make a catch-up entry. I underapplied, so I'm going to have to add this. Now, I'm labeling it as unfavorable. Why? Because I'm adding it to cost. It's going to have the impact of reducing my overall income because I have to recognize that additional. Now, if my production had been greater than 500, this could be favorable. I would subtract this from my cost of goods sold. In essence, what I'm doing is adding this. Now, if you wanted to do this, in some ways it may make a little bit more sense, I could actually switch these two numbers. Take the 7.7, add the 400,000, then subtract out the ending inventory. In some ways, I think that makes a little bit more sense. But this would be in addition to my cost of goods sold. If I overproduce, I need to pull out some of those fixed manufacturing costs. So it would be a reduction in cost of goods sold. Okay, the favorable, unfavorable is going to have to be put in there. Again, these fixed costs don't change, and the fixed operating costs don't change. Okay. I'm sorry. The variable cost, okay, are going to be a little bit different. Okay, my marketing costs are a function of my sales. Since I'm selling more, my variable marketing costs are going to go up, but my fixed non-manufacturing costs are going to be the same. Now you'll notice again, oops, if I can get this out of the way here. Okay, in a month in which the sales were less than production, okay, that under variable costing we came up with the 1.25 million and under absorption 1.85. Why? Because of the 150 units that are sitting in ending inventory times the variable manufacturing cost, the fixed manufacturing cost. Okay, the inventory, okay, the change in inventory explains the change in the differences in the cost here. Because inventory is going down, my absorption costing is going to be less. Because why? I'm picking up some of the costs that I deferred from last period and recognizing them in this period. So again, if I take 150 units times 4,000, that gives me 600,000, which is exactly the difference between these two numbers here. And that's the amount of fixed manufacturing costs that's still sitting in ending inventory, which I'm not going to recognize under absorption. That 600,000 essentially gets recognized here in May. So that's going to be, May's going to have its own cost, its own production cost, plus it's going to pick up 600,000 of plus or minus a little bit of adjustment with inventory to account for the total cost in May. Okay, the change in inventory in May was a minus 120. So we went from 150 units here to 30, that's minus 120. If I take 120 units times the 4,000, it gives me 480,000, which is exactly the difference between this income figure of 3.12 million and 2.64 million. So I can always explain the difference from one month or one period to the other by number one, the change in inventory, and number two, the fixed manufacturing cost per unit. That explains the difference here. Okay, the last one we're going to take a look at here is number 26, which looks at the issue of capacity. Capacity is a very difficult issue. It ties in a lot with the issue of strategic planning, and that is what kind of facilities do we need, both in production, to accommodate what demand? And so it's a big risk that companies make. It's a huge risk in the sense that how many millions of dollars are we going to tie up in fixed equipment and factory machinery and things like that, and for the reason that, we expect this demand to be. And so if you overestimate your demand, you have a lot of facilities, and you're incurring a lot of cost, but you're not getting a return for it. If you tend to underestimate it, people will say, well, what's the problem with that? Well, it means I have to go back into the market to get additional money, additional financing to buy a new factory. And that can be a very expensive proposition too. So, or you may not get it if the market just thinks that you're not being really good in terms of predicting demand. So the choice here is, it's a difficult one, and it's something that the chapter doesn't really get into. They just simply give you, here are the fixed cost, okay, what's the capacity. It also ties into what cost, remember back when we looked at absorption costing, and we took the fixed cost and divided by an activity, namely production. Well, what production level am I going to use? Because the higher my production level, the less my fixed cost is going to be. If I can produce more, then I can actually charge less and still make a profit. If I produce less, it means I need to charge more to recover my cost. And so it sort of explains too, if you kind of view the changes in equipment that is going from one factory to two factories, going from, let's say, $5 million of fixed cost to $10 million of fixed cost. Well, a lot of companies, they're really reluctant to make the adjustment. Why? Because they know that, once we bump up against capacity, if we think we're going to exceed it, then suddenly we've doubled our fixed cost, which means our cost per unit is going to go up astronomically. And the demand may be just a little bit on the other side. Do I really want to go after a smaller increase in demand, but an enormous change in my fixed cost? So many companies will stay below, they're kind of happy where they are, simply because they know they can be profitable at that point. Now, at some point, they may be looking forward and say, at some point in the future, we think the demand can be there, therefore now we're going to make the jump and increase our capacity. But until you know that you can get far beyond a certain level of production and sales, you don't really want to make the jump up, especially if it's only going to be a marginal increase, because that marginal increase in sales will not cover the huge change in fixed cost. All right, now, in this case, again, kind of going back to the issue of definitions of capacity, theoretical, practical, normal, and master budget. I'm kind of drawing a line here because theoretical and practical are based on what we can do, based on what the machinery will allow us to do. Normal and master budget are based on what the market is telling us people want. Okay, so one is based on what we can do, the other is based on what we should do. Now, it's easy enough to say, here are my fixed costs per unit, or fixed cost over a period of time, and here are the various levels of activity associated with each of those levels of capacity. So therefore, here's my fixed cost per unit. I mean, that's kind of the simple mathematical part of it. The problem is, which of these do I choose? That's really the difficult part for a company to make a decision. Most companies tend to, from a very, I hate to use the kind of double word, practical, but they tend to either use a practical or normal capacity. Theoretical is just not going to happen. Okay, it's unrealistic for a lot of reasons. And And so when they're looking at capacity, they're looking at, okay, practical capacity, what can we do? Normal capacity being, okay, what should we do? And based on that, we're going to then allocate the fixed cost per unit. Okay, for your purposes, for exams and things, I will give you, you may be asked some conceptual questions, what is theoretical capacity, etc. What is master budget? I may give you something like this, is okay, what would be the fixed cost per unit? And kind of understand. So the mathematical part is fairly straightforward. The definitional part of it, you're going to have to know how to do. But the other part of it is why would I choose one level of capacity over another? As I said, from a very simple point of view, most companies will choose either practical or normal and base their equipment needs on that rather than on normal, than either theoretical or master budget. Okay, now one part of this chapter that I have not included and I will not cover on exam, so you don't need to worry about it, is the throughput costing. Throughput costing is sort of like variable costing, but it's an extreme version of it. So it's probably something that's not going to show up very often on a CPA exam. Most companies are very comfortable using variable costing. And so throughput costing really doesn't give you a whole lot more information than I can achieve with variable costing. And since most people are somewhat familiar with variable costing because they've studied it and doing CVP analysis and calculating contribution margin, there's no reason to go to the extreme of calculating an income statement using throughput costing. And we'll kind of leave it at that. So you don't need to worry about it. You may see there may be a homework question here or there that'll deal with throughput costing, but I will not ask any questions on the exam involving throughput costing.